Welcome to the ZICA Academy YouTube channel. In this lecture, I want to examine IAS 33, earning per share. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. Earning per share. What do we mean by earning? Earnings. Earnings are profit available for equity. That is profit available to equity holders. Profit available to ordinary shareholders. That is what we mean by earnings. So the word earnings means profit. Profit available to ordinary shareholders. Profits available to ordinary shareholders. It means to get the profit available to the shareholders or ordinary shareholders, the interest due to loan providers will have been deducted. Dividend due to preference shares will have been deducted. So in arriving at, or before you can arrive at earnings available to ordinary shareholders. So what do we mean by earning per share? Earning per share, EPS, earning per share. Earning per share is the profit in the year. Profit in the year divided by the number of ordinary shares in that year. The earnings that is due to one ordinary shares. That is, earning per share is earnings, that is profit. That is profit divided by number of ordinary share in EU. So the profit available to one or to a unit of ordinary shares, that is earning per share. Profit that is available to a unit of ordinary share is said to be the earning per shares. EPS. To calculate your EPS, you have the net profit or loss for the year. Net profit or loss. It could be a loss, it could be a profit for the year, minus preference shares dividend. Preference share dividend divided by number of ordinary shares, ordinary shares in EU. So this will give you the earning per share. The profit that is due to ordinary shares minus preference shares dividend over number of ordinary shares in EU and ranking for dividends. That will give you the earning per shares. Remember, in accordance with IAS 32, financial instrument presentation. Instruments. Presentation. Which categorize preference shares into two. Preference shares were categorized into two. We have the redeemable preference shares and irredeemable preference shares. In accordance with the provisions in IAS 32, redeemable preference shares is a debt instrument. Being a debt instrument, the dividend due to a redeemable preference shares is usually recognized as a finance cost. That is, We normally recognize the dividend due to a redeemable preference shares as a finance cost, that is interest. We treat it like interest in the statement of profit or loss. In that case, where the preference shares is redeemable, the dividend due to them will have been deducted before arriving at the net profit, that is the profit for the year, in the statement of profit or loss. If redeemable preference shares, it is a debt instrument, we said its dividend will be treated as finance cost. If you go by the format for published financial statement in accordance with the provisions in IAS 1, we used to start with the revenue, cost of sales, that will give you gross profit. Then you consider your distribution cost, administrative expenses, you arrive at the operating profit before you consider other income and interest, your finance cost, in order to get the profit before tax. So if a preference shares is redeemable, its dividend will have been treated as part of the finance cost. In that case, the preference dividend have been deducted before arriving at this profit. You don't need to deduct it again to avoid recording the same dividend twice, since it has been deducted before arriving at the profit for the year or profit before tax. That dividend has been deducted, so you don't need to deduct it again. But if it is irredeemable, an irredeemable preference shares is an equity instrument. Since it is an equity, dividend due to irredeemable preference shares will be used in the statement of changes in equity, statement of changes in equity. So since that dividend will be used in the statement of changes in equity, such dividend have not been deducted before arriving at the net profit or profit for the year. So in that case, you will need to deduct it, since it have not been deducted, because preference shares normally receive a preferential treatment. So it will not be treated as part of ordinary shares. So that is why you will need to deduct dividend due to irredeemable preference shares, which have not been deducted before arriving at the net profit or losses for the year. Please take note of that. Now, the problem with the calculation of earning per share is the denominator, which is the number of ordinary shares in issue. Hitherto, I will be using the term weighted average number of shares in issued. Weighted average number of ordinary shares in issue in the denominator. Why weighted? Because a number of ordinary shares may be issued at different time, different month, different days of the year. So you will need to apply time apportionment to that. You will need to apportion it based on the time it was issued. That is why I'll be using weighted average number of ordinary shares. I've told you the problem with the calculation of EPS is the denominator. Now, how do you calculate the weighted average number of ordinary shares in issue? I want to give you this as a format. You may start with date. You have a column for date or period it was issued. Then you may also have number of shares issued. Number of shares issued. Then after number of shares issued, then you have cumulative number of shares issued. Cumulative number of shares issued. Then you now you multiply this by time factor. Time factor. So the result obtained will be the weighted average number of shares issued. Weighted average number of shares issued. Please watch this video to the end for better understanding. So types of issue. Types of issue. We will categorize issues into two. Number one, we have public issue. Public issue and private issue. Public issue is the issue of shares to the member of the public at the prevailing market price. The issue of shares to the member of the public at the market price. That is public issue. This issue is made at the market price. And the second type of issue is private issue. So this issue is not made to the members of the public. It is made to the existing shareholders. The private issues are made to the existing shareholders. This private issue, we will categorize that into two. We have the bonus issue, and right issue. I will leave private issue for another video. But in this very one, I want to concentrate on public issue. I've given you the format for calculating the weighted average number of ordinary shares in issue, which will be used in calculating the earning per share. Example 1. Gerard's earnings for the year ended 31st December 20x4 are $2,208,000. On 1st of January 20x4, the issued share capital of Gerard was 8,280,000 ordinary shares of $1 each. The company issued 3,312,000 shares at full market value on 30th of June 20x4. Calculate the EPS for Gerard for 20x4. This question is obtained from Kaplan, ACCA study test. Now, solution. The name of the entity is Gerard. We have Gerard. So you have to calculate the EPS for Gerard for 20x4. Calculation of earning per share. We say EPS is profit after tax, that is profit attributable to equity. There is no preference shares, so there is no preference dividend. Overweighted average number of ordinary shares in EU. So if there is preference shares, then you will need to remove the preference shares dividend. So, and you are given the profit. You were to derive earnings for the year ended. So this is the profit. So this is the numerator. Earnings. I've told you earnings is profit. So your numerator is $2,208,000. On January 20x4, we want to calculate the weighted number of ordinary shares in issued. Working one. Weighted average number of ordinary shares in issue. So I've told you you will have a column for date or period. Date or period. Then we have the number of shares issued. Number of shares issued. Then you have cumulative number of shares issued. Cumulative number of shares issued. Then you now multiply by the time factor. Time factor. Then the result obtained will be weighted average number of shares. So, you were told on 1st of January 20x4, the issued share capital of Gerard was 8,280,000 ordinary shares. On the 1st of January, January 1. So let me say balance brought forward. The shares you have is 8,280,000 shares. That is the existing shares as at the 1st of January. Then the company issued 3,312,000 shares at full market value on 30th of June 20x4. On June 30, another shares were issued. The shares issued is 3,312,000. So the cumulative shares now will be 8,280,000. 8,280,000 plus 3,312,000. So the cumulative number of shares is, as at the end of June, is 11,592,000. This is the cumulative number of shares as at the end of June. So you want to calculate the EPS. Remember, the next issue were made as at June. It means the one in existence will be, the entity will be used, will be in existence. The first shares will be in existence from January 1 to June 30. A period from January 1 to June 30 before the next shares were issued is a period of 6 months. This is 6 months period. 6 months. So that means time factor to use to multiply this will be 6/12. This second issued will be in existence till December, since the year end of the entity is 31st of December 20x4. So this one will be in existence from June 30 to December 31st. You can't count June because it happened at the end of June. So that means you start counting because June has been counted as part of this period. So you count from July to December. That is another 6 months. 6 out of 12. Now, let's apply that time factor on the shares. 8,280,000 times 6/12. That gives us 4,140,000 shares. Weighted average number of shares. This is 4,140,000 shares. The second one, we have 11,592,000. 11,592,000 times 6 divided by 12. That also gives us 5,796,000. So by the time you sum them up, you will get the weighted average number of shares in issued. So the total is 9,936,000. It is the weighted average number. It is this result that will be used to calculate our EPS. So our weighted average number of shares in issued is 9,936,000. With this, we want to calculate EPS. EPS, which is profit attributable to equity. We have 2,208,000 as the profit, as the earnings. 2,208,000. That is the earnings. Over weighted average number of ordinary shares in yield. So 2,208,000 divided by 9,936,000. So we get $0.22. $0.22 per share. Or if you like, you can put 22 cents or 22 cents. So this is the solution to example 1. Example 2. Company B has a financial year ending 31st December. On 1st of January year 3, there were 9 million ordinary shares in issue. On May 1st, Company B issued 1.2 million new shares at full market price. On October 1st, on 1st October, it issued a further 1.8 million shares, also at full market price. Total earnings in year 3 were 36.9 million naira. Calculate the EPS for year to 31st December year 3. So this question is obtained from ICAN study test. It is a practice question in ICAN study test by Emily Wolf Publishers. The same question can be obtained from ACCA study test. Now, let's have the solution to example 2. The name of the entity is Company B. I've told you the problem area is the calculation of weighted number of ordinary shares. So now let's have calculation of weighted average number of ordinary shares in issue. So we used to have date, number of shares issued. Then you have cumulative number of shares. Cumulative number of shares. Then we have time factor. Then we have weighted average number of shares. So back to the question. All this information happens in year 3. Company B has a financial year ending 31st December. On 1st of January year 3, there were 9 million ordinary shares in issue. January 1, the balance brought forward, number of shares issued is 9 million. Let me say balance brought forward. 9 million ordinary shares. That is January 1st. On 1st of May, Company B issued 1.2 million new shares at full market price. May 1st, they issued 1.2 million. So the cumulative number of shares in May increases to 10.2 million shares. Then on October 1st, it issued a further 1.8 million shares, also at full market price. October 1st, it issued another 1.8 million shares. The cumulative number of shares becomes 12 million. Now, we want to multiply it by the time factor. From January, the next issue were made in May 1st. That means this will run from January 1st to April 31st before the next issue will be made on the 1st of May. How many months is that? January, February, March, April, 4 months. So the time factor to use here will be times 4 over 12. This was issued in May 1st. The next issue will be made in October 1st. That means we have to September 30. Now, how many months is that? May, June, July, August, September. That is 5 months times 5 over 12. Now, the year end is December 31st. That means this one will be from October 1st to December 31st. How many months is that? October, November, December. 3 months. So we have times 3 over 12. Now, 9 million times 4 over 12. That gives us 3 million shares. 10.2 million times 5 divided by 12. That gives us 4,250,000 shares. 12 million times 3 over 12. That gives us 3 million. 3 million shares. If you sum them up, so you have 10,250,000. That is the weighted average number of shares in issued. Weighted average number of shares in issued is 10,250,000. So to compute the EPS now, earning per shares, that is earnings, which is profit. You were to total earnings in year 3 were 36.9 million. So 36.9 million, that is the total profit. Over number of shares in issue, which is 10,250,000 shares. 36.9 million divided by 10,250,000. That gives us 3.6. 3 naira 60 kobo per share. That is earning per share. So this is how to solve questions involving issued at full market price, that is the public issue. So in my next video, I will examine the bonus issues and the right issues. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.